A frequently asked question on my YouTube channel is, what insurance company do you use, Doug? What factors should one consider when choosing an IUL? Great question. In this episode, I'm going to explain first and foremost why it doesn't matter that much which company you choose or which product. I'll give you some criteria for maybe narrowing down which ones you choose, but it's more important how you structure the policy and fund it. That will make all the difference in the world. And if you have annual reviews and you diversify and rebalance, that is the biggest factor. I can make almost any IUL policy perform well when you structure it correctly. If you want to tweak it, out of maybe 70 different companies and their products, I'm pretty picky. I may only put my money in maybe a dozen of them. And so I'm going to give you insights on that. So here we go. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize assets, minimize taxes, prepare for long-term goals such as retirement by using superior capital accumulation vehicles that accumulate money tax-free, generate tax-free income at like 10% payouts. And at the end of the day, when they die, it blossoms and transfers tax-free. Nothing else does that in the Internal Revenue Code than a property structured, max funded, indexed universal life policy. Okay. It's my favorite vehicle without question. And many of our clients have averaged over the long haul in excess of 11% and netted within 1%, like 10% rate of return. And so that every $1 million they accumulate can generate $100,000 a year of tax-free income without depleting principal. Most people in America would have to be earning 15% in the market in an IRA or 401k to net 10 after paying tax in a 33% tax bracket. Why do you want to have to earn 15 to net 10 when you can way more safely earn 11 and net 10 by using IUL and it's tax-free? Okay. So then people start getting these insights and they go, okay, the magic is, which company do you use, Doug? Well, again, that doesn't matter as much. If you're structuring it correctly and funding it properly, why is it my choice? Because for long-term goals such as retirement, but even college funding, business working capital, estate planning, and so forth, it eliminates 3 big dangers better than any other financial instrument. This is what causes most retirees to outlive their money: taxes, inflation, and market volatility. IUL eliminates those. You're immune from those. Why? Because you're converting to tax-free. It doesn't matter what taxes go to. My money in an IUL is tax-free. Inflation. I don't like inflation any more than you do, but it doesn't hurt me. It helps me because I link my returns to the things that inflate. I've always outpaced inflation by linking to an index and rebalancing. When inflation goes to 5, I've usually earned over 10. If it goes to 10, I earn over 15. During COVID-19, when it went to 15, I earned 25, even 61, and even 158%. Okay. So when you understand that, you don't worry. I can outpace inflation. The third is indexing, where if the market's going up, I get to benefit. But if the market crashes, I don't lose because my money is not in the market. Okay. It's linked. The 3 biggest strengths of IUL is liquidity, the ability to access my money when I need it. Number 2 is safety, not only of the institution, but safety of principal. If I set aside $500,000 into an IUL policy, I don't want to lose that principal of $500,000. But more importantly, if that $500,000 grows to $1 million, I do not want to lose the money I made in future years. You lock in your gains every year on IUL and you reset. So I don't want to lose in future years money I made in previous years. So I want safety of principal. And any year I make money, I want that money I made to become newly protected principal. Many advisors have no clue how to do that one. And then to earn a predictable rate of return, not pie in the sky. I mean, yes, if you diversify and rebalance, you will have years where our clients get credited 25%, 61%, 158%, not year in and year out. But those years offset the years where the market crashes and our clients didn't lose, but they didn't make anything. A zero was the hero. But our average returns, because of rebalancing, go from maybe 8% up to 11 to 14%. They are able to earn 11 and net 10, where the cost of insurance is only 1%. I can earn 11 and net 10. And so every million can generate 100,000 a year tax-free income. 10% means my money will double every 7.2 years. It's not simple, okay? So to make sure you understand this, which insurance company do you use? If you structure the policy correctly and fund it properly, no matter which company or which product, if you understand how to do it correctly, under Section 101A of the code, you're taking the least death benefit required by the IRS under TEFRA and DEFRA tax citations under Section 101A, so that your money is tax-free, not only when you die, but by taking the least amount of insurance. The insurance gets cheaper as you get older, because TEFRA and DEFRA gives you parity. The older you are, the less insurance you're required to have. So the cost of insurance is the same, whether you're 20, 60, or age 80. If you don't understand this, you've got to watch some other episodes on my channel. But the insurance actually gets cheaper as you get older, as you fill up the policy, because you self-insure. Your cash value will usually grow to equal and then exceed the death benefit within 11 to 15 years. The cost of insurance basically is nothing. After that, you're self-insured. Now, 72E of the Internal Revenue Code says that any money inside the insurance policy grows tax-free. 7702 says when you start taking out income, $1 million generating 100,000 a year of income, that's totally tax-free if you do it the smart way, okay? Which is via loans. You want to borrow from the insurance company the equivalent of your interest, because they're going to keep crediting you oftentimes 100% more than they're charging you by using the loan feature. The loan is not due and payable in your lifetime. It's a phantom loan. It's washed away when you die. But loan proceeds are tax-free. And I usually get credited twice as much as they're charging for the loan. So I continue to make 100% more than the cost when I use a loan. Watch other episodes if you're going, what are you talking about? Okay. So Tamara talks about how fast you can fund it. So I often compare IUL to a bucket. So here we go. It doesn't matter which insurance company or which insurance policy with that company. If that IUL policy is structured so that under TEFRA and DEFRA and TAMRA, I'm going to fill it up as fast as the TAMRA and the TEFRA and DEFRA allow. If I'm 60 years old and I want to reposition 500 grand, and my objective is living benefits, it doesn't matter which company or which product, I'm going to go in and say, what's the least amount of insurance I can get away with to accommodate 500,000? That's going to be about $1 million, no matter which company you're using. It's going to be, give or take, a few $1,000s. So you simply structure any IUL to take the least death benefit. And then if you're older, you take the level death benefit. If you're younger, you use the increasing death benefit. If you're just funding it monthly until you stop funding it, then you switch to the level death benefit. So this spigot gets smaller. It gets cheaper as you get older. Okay. You don't care about the death benefit. What do I mean? With this example, if this 60-year-old is funding this in compliance with TAMRA, maybe he can only put in $125,000 the first day of the first year. He only funds it 25% of the way. The first day of the second year, he can now put in another 125. Now it's 50% funded. Okay. And then the next year, 2 years and 1 day, he can put in, it's now 75% funded. It's got $375,000 in it. In 3 years and 1 day, now he has his $500,000 in there. And so you can fill that up. You can put in $100,000 a year in 4 years in 1 day and have your 500 grand in there. If you structure it correctly, that becomes part of the death benefit. I don't want that added on top of that because they're going to keep charging me for $1 million. I don't care about the death benefit. I want to maximize my return. I want the insurance to get cheaper as I get older. If I have 500 grand in there by 4 years, and if I die, they still pay out $1 million. but 500,000 of that million was my own money. They're only at risk for the remaining 500,000. They're only charging me for half as much risk as they did 4 years earlier. The spigot on the bucket is half what it was 4 years earlier. The insurance getting cheaper as I get older. If this 500,000 doubles to $1 million in 7.5 years, which it usually does, based on rebalancing, now I have $1 million. If I die, they pay out $1 million. They simply paid me my money in the policy. It's tax-free because of Section 101A. What was the cost of insurance? Basically zilch, because my cash now equaled the death benefit. In reality, Tefra Defra says the insurance company will pay you 5% more. They'd pay out $1,050,000, but the cost of $50,000 of insurance is minuscule compared to the money you're making on your million. The insurance is costing you 1/20th what it did, 12 years earlier. That million can generate 100,000 a year of tax-free income if you're 120, because the insurance keeps getting cheaper as you get older. If you don't need the money, the million doubles to 2 million in another 7.5 years. 2 million, if you die, they pay out 2.1 million. But see, your cash now, you're self-insuring. The cost of the insurance is getting cheaper as you get older, which means in the 20th year, if I earned 11, I would probably net that year 10.9. Retroactive back to day one, if I earned 11, I probably netted 10. Because of the early years when the bucket was only 20% or 25%, 50% funded, okay? But when you structure it correctly and fund it properly, the point I'm making is I could take any IUL offered out there and structure it like I'm talking about if you know what you're doing. And then you want to rebalance, have annual reviews to tweak it. So that comes next. So more important than the company or the product, then out of 70 different companies out there, I'm sort of picky. I like to use companies that are rated high on the Comdex score. The Comdex score is a combination of 5 different rating agencies because it's confusing, AM Best or Moody's or Fitch or whatever. So a Comdex score, I like to choose an insurance company that has a Comdex score of 90 or higher, which means 90% of companies are rated less than this one. I like to use it because Comdex scores show companies that have good track records, that have been around. They have, they treat their old policyholders the same as brand new ones, and they have a track record of keeping their costs down, things like that. So to be honest with you, maybe out of 70 companies, I would only put my money in maybe 10 or 12 of them, because the others would not have a Comdex score of 90 or higher. Okay, that's just me. So check out their Comdex score. Now, when we talk about choosing which company, hopefully you understand it doesn't really matter if you structure it like I'm talking about. If you're wanting to go with a company that has a high Comdex score, just go in and ask for their Comdex score and choose maybe one of the top 10 or 12 that have Comdex scores that meet your criteria over 85, over 90, or what have you, okay? Now, we have an organization for IUL agents called IUL Insiders. And they are always wanting to know, so which carriers do you use, Doug? We aren't trying to convince them to use our carriers. So we have nothing to hide, and so we created a matrix. And so we created a matrix of all the major insurance companies that offer IUL and their products. And in this matrix, depending upon your objective, if you're wanting to access money under tax-free loans starting the second year, there's only certain products that allow you to do that. If you want a company that allows an index loan instead of a standard loan after 5 years instead of waiting 10 years, there's only certain companies and products that allow you to do that. If you're a business owner and you want a waiver of surrender, you want to have 100% access to all of your cash value, even in the second and third year, you're not doing it so much for the rate of return down the road. You're willing to give up a little bit of rate of return to have 100% access to your money. This matrix shows you which companies do that. Which companies offer different indexing strategies, linking methods, threshold strategies, so that like in COVID-19, we called 800 of our clients and had them switch to a 1-year point-to-point with no cap. And they got credited 61.33% up to 158% in one single year. Well, there's only certain companies that have threshold strategies like that. There's only certain companies that have multipliers that allowed clients in March of 2020 to March of 2021 to not only get credited 61.33%, but 158% by having multipliers. I'm not going to go into multipliers here, but when you understand how money works, if you want to use multipliers, there's only a handful of IUL companies that offer those, okay? Who are they? Well, there's companies like Pacific Life, and they have a great Comdex score. There's other companies like Nationwide, but there's a lot of companies out there, Allianz, National Life, F&G, Lincoln. There's a lot of different companies that have great products. It's not so much the company, okay? It's the company and the product based upon what is it your objective, which IUL maybe has the features based upon your objectives, which loan provisions, which indexing strategies, linking methods, threshold strategies when you want to switch from a cap to a threshold strategy, which has the higher Comdex score, which ones have a better track record. All of these insurance companies should be legal reserve insurance companies, which means they all have to have legal reserves on hand that are liquid and safe, that if there was a run on banks, credit unions, and insurance companies, legal reserve insurance companies, this is where banks and credit unions put their money, their tier one assets for liquidity and safety. So any of these insurance companies should be legal reserve companies, which means if there was a run on an insurance company and they were deemed insolvent until they could liquidate their bonds and mortgages or whatever, it means if you died, all the other insurance companies licensed in that state have to ante up and honor the death benefit because they cross-insure each other until that company can liquidate assets or it's purchased by another company. That is way better than FDIC, which is simply Federal Deposit Insurance. And of course, the government can raise taxes and so forth and print money, but I would rather have my money in a legal reserve insurance company any day than a bank or a credit union. Having said that, I get a little bit picky, and I usually put my money in maybe 10 or 12 of the 70 because of all this criteria I've been talking about. If you want to see the matrix, if you're an agent and you want to understand, which products and which companies might be best suited for this or that goal, I would recommend that you check out IULinsiders.com, okay? And so, folks, here's what I would recommend. To understand all of this, you can go to laserfund.com and you can contribute a nominal amount towards the shipping and handling of my most recent best-selling 300-page book that is full of all kinds of charts and graphs and explanations and 62 actual client stories. I'll cover the rest of the shipping and handling, and I'll pay for the book and fire out a hard copy to you. Yeah, it retails on Amazon for $20 up to $70. I'll pay for the book. But hey, if this is resonating with you, here's the next step. I would recommend that you click on this episode next and go into a deeper dive, a different perspective of what I'm talking about so that you understand it's not really the insurance company or the product that is the main consideration. It's structuring it correctly, funding it properly, and which features and benefits are going to help you achieve your goals the best.